This briefing is meant to share with the press a summary of the key discussions and decision on the monetary policy stance as part of our commitment to transparency and accountability. Global economic developments in the first 4 months of this year were characterized by low growth prospects, unsynchronized disinflation outcomes, and restrictive global financial conditions driven largely by significant wins with the policy shifts in the United States. The potential spillover effects of the imposition of the trade tariffs by the United States and counter-tariff measures have heightened policy uncertainty, weakened investor sentiments, and lowered global growth prospects. In the actions by central banks have been made, reflecting divergence in inflation outcomes. While some countries said tighter for longer stance, others have cut policies, citing a gradual ease in inflation towards central bank targets. On the domestic front, the bank's high-frequency real sector indicators point economic. The updated index of economic activity increased by 2.3% year-on-year in March 2025, compared with 1.0%, the 50 benchmark, as output and new orders increased, signaling improved growth prospects. Based on easing inflationary pressures and optimism about macroeconomic conditions, the latest confidence surveys showed significant improvement in consumer and business indices, the highest in the last 7 years. Headline inflation has declined consecutively in the first 4 months of the year by 2.6 percentage points to 21.2% in April 2025, and this was driven by both food and non-food inflation. A confluence of factors, including tight monetary policy stance, stepped up liquidity sterilization efforts, downward revisions in ex-pump petroleum prices, and exchange rate stability have supported the gradual decline in inflation. The bank's core inflation measure, which includes energy and utility prices, as well as inflation expectations of consumers, businesses, and the banking sector, point to easing inflationary pressures. Fiscal policy implementation so far has been broadly aligned with the 2025 budget. In the first quarter of 2025, provisional data on budget execution indicated that although revenues fell below target, some expenditure rationalization took place to accommodate the revenue shortfall. The primary fiscal balance, and that is on commitment basis, has also improved in the first quarter. At the end of March 2025, the stock of public debt stood at 769.4 billion Ghana cedis, which constituted 55.0% of GDP, compared with 726.7 billion Ghana cedis, which constituted 61.8% of GDP at end December 2024. Continued maintenance of a strict fiscal consolidation for the 2025 fiscal year will further strengthen the ongoing recovery process and firm up macroeconomic stability. On the external sector, the sector has continued to improve, with a record provisional current account surplus of $2.1 billion in the first quarter of 2025, and this was driven mainly by higher prices and increased production volumes of gold and cocoa and strong remittance inflows. The current account surplus, together with net outflows in the capital and financial account, resulted in an overall balance of payments surplus of $1.1 billion. The strong external performance resulted in significant reserve accumulation. Gross international reserves amounted to $10.7 billion in April 2025, and this was equivalent to 4.7 months of imports of goods and services. Imports of goods and services. Broadly, the external sector outlook remains favorable, largely anchored on expectations of increased gold and cocoa export receipts, as well as inflows from remittances. On the local currency, the cedi has rebounded strongly against the major trading currencies, and this was driven by a combination of factors. And this includes tight monetary policy stance, ongoing fiscal consolidation, record reserve accumulation, strict enforcement of foreign exchange market rules, and improved market sentiments. In the year to May 21st, 2025, the cedi had appreciated against all the major currencies, and that was 24.1% against the US dollar, 16.2% against the British pound, and 14.1% against the euro. The latest forecast points to continued easing of inflationary pressures on the back of tight monetary policy stance, exchange rate stability, and fiscal consolidation. Inflation is expected to ease faster towards the medium-term target in the first quarter of next year, that is 2026, as opposed to the second quarter as earlier envisaged, and this is barring unanticipated shocks. Despite these positive developments, the committee observed that the current level of inflation remains high relative to the medium-term target and will require maintaining the tight stance to reinforce the disinflation process. Under the circumstances, the committee, by a unanimous decision, maintained the policy rate at 28.0%. On the additional policy measure that was taken by the committee decided to amend the dynamic cash reserve ratio that exists currently as follows. The CRR, or the dynamic cash reserve ratio, for all banks will now be maintained in their respective currencies. This means that foreign currency reserves for foreign currency deposits, and the same way domestic currency reserves for domestic currency deposits. This policy measure will become effective on June 5, 2025. For an informational note, the next Monetary Policy Committee meeting is scheduled to start on Wednesday, July 21st, 2025, and will conclude on Friday, July 25, 2025, with the announcement of the policy decision, the next by the Monetary Policy Committee. Thank you very much.